Making Peace with Uncle Sam. Making Peace with Uncle Sam. How to Stop Dreading April 15th and Start Profiting from the Tax Code. Earning is not the only way to make money. You can make money by reducing expenses, and there is no greater expense than taxes. Eugene Han. Every April, millions of Americans open an envelope from the IRS and feel that familiar mixture of dread, confusion, and outright resentment. It's the same feeling that drove patriots to dump tea into Boston Harbor in 1773. The visceral objection to handing over hard-earned money to a government that seems to spend it in ways you never approved. The difference between then and now is that today, if you understand the rules of the game, you can legally keep far more of your money than you might ever have imagined. Here's the number most people never fully reckon with. According to a 2024 study, the average Texan will hand over roughly 37% of their lifetime earnings to taxes. Tax Freedom Day. The date when the average American has theoretically earned enough to cover the entire year's tax bill falls around mid-April. For nearly 4 months every year, you are working not for yourself, but for federal, state, and local governments. The good news, the code is not just a set of obligations. It is also a roadmap of incentives, a system designed, often deliberately, to reward certain behaviors like investing, owning a business, and saving for retirement. Those who learn to read that roadmap don't just avoid paying too much. They use the tax code as an engine for building wealth. A note on tax history. The income tax has existed in its current form since February 3, 1913, when the 16th Amendment gave Congress permanent authority to tax income. In the century since, top marginal rates have swung from 1% to 94% and back again, cut dramatically under Kennedy, Reagan, Bush, and Trump, and raised under Roosevelt, Truman, and Clinton. The trajectory has never been straight in either direction. This matters for one practical reason. Tax policy is not carved in stone. It is negotiated, contested, and periodically overhauled. The strategies in this chapter are legal and effective today, but the investor who stays educated and nimble will always find opportunities that the passive taxpayer misses. Why taxes exist? The 4 R's. 1. Revenue. The most obvious purpose. Taxes fund the roads you drive on, the schools your children attend, the courts that protect your contracts, and the military that guards your borders. 2. Redistribution. Taxes transfer resources from higher-income households to lower-income ones through progressive tax rates and social programs. 3. Repricing. Governments use taxes to change behavior. Cigarette taxes discourage smoking. Proposed carbon taxes aim to reduce greenhouse gas emissions. Conversely, tax breaks for retirement savings and homeownership are government nudges toward behaviors considered socially beneficial. 4. Representation. This is the most historically profound purpose. No taxation without representation was not merely a colonial slogan, it captured a deep truth about power. When citizens pay direct taxes, they demand accountability from their governments. How do U.S. taxes compare? As a share of GDP, Americans pay relatively low taxes. The U.S. ranks 32nd out of 38 OECD, i.e. in developed nations. But 44% of U.S. tax revenue comes from personal income taxes, compared to just 24% on average in other developed countries. In America, employees bear a disproportionately heavy share of the tax burden. The lesson is not to complain, it's to move up the ladder from employee to employer to investor. The Great Divide, employee, employer, investor. Warren Buffett, the legendary investor from Omaha, once quipped that he pays a lower tax rate than his own secretary, 17.4% on his dividend income versus 35.8% on her wages. His point was not to brag, it was to illuminate a structural feature of the American tax code that most people never learn about until it's too late to act on. The American tax code effectively divides people into 3 economic tiers, each taxed at a very different rate. Understanding which tier you are in, and how to move up the ladder, is one of the most important things you can learn about building wealth. The first tier is the employee. If you earn a salary or hourly wages, your income is subject to ordinary income tax rates, which can reach as high as 37% at the federal level. There is one partial advantage here. Your employer pays half of your FICA taxes, the Social Security and Medicare contributions, so you only see half of that burden directly. But make no mistake, employees bear the heaviest tax load of the three tiers. The government collects its share before you ever see your paycheck. The second tier is the self-employed person or employer, the business owner. Your income is still subject to ordinary income tax rates, and you now pay both halves of FICA yourself, which can sting at first. But the trade-off is significant. Business owners have access to a wide range of deductions that employees simply don't have. Your home office, your vehicle, your health insurance premiums, your retirement plan contributions, your professional development, all of these can reduce your taxable income, sometimes dramatically. The effective tax rate for a savvy business owner can be far lower than their headline income would suggest. The third tier is the investor. This is where the tax code becomes genuinely generous. Long-term capital gains, profits from assets held for more than 1 year, are taxed at rates of 0, 15, or 20%, depending on your total income. Compare that to the 37% top rate on ordinary wages, and the advantage becomes vivid. Warren Buffett famously pointed out that he pays a lower tax rate than his own secretary, not because of any loophole or special arrangement, but simply because most of his income comes from investments rather than a paycheck. The practical lesson here is this. Your goal over time is to migrate from the first tier toward the third. You don't have to abandon your career overnight, but every step you take toward building investment income, index funds, rental properties, dividend-paying assets, moves more of your earnings into a category the government taxes far more lightly. The tax code is not neutral. It rewards investors. The sooner you understand that, the sooner you can make it work in your favor. The difference between these tiers is not a matter of luck or injustice. It's a matter of financial literacy and intentional planning. Your goal, over time, should be to migrate from the employee column toward the investor column. Capital gains, the investor's best friend. What is a capital gain? When you buy an asset, a stock, a rental property, a business, and later sell it for more than you paid, the profit is called a capital gain. The IRS taxes that gain, but crucially, only when you sell. While you hold the asset, no tax is due, regardless of how much it has appreciated. Short-term capital gains, held less than 1 year, taxed at exactly the same rates as ordinary income, up to 37% at the highest bracket. This is the tax fate of the impatient investor who buys and sells quickly. There is almost never a good reason to sell a winning investment in under a year. Long-term capital gains, held more than 1 year. Here is where the investor's advantage becomes vivid. Consider the long-term capital gains rates for 2025. If you're a single filer earning under $48,350 in total taxable income, you owe 0 federal tax on your long-term investment gains. That is not a typo. And at the 15% bracket, compare this against the 32% that earned income faces above $197,000. The spread is 17 percentage points, a colossal advantage for the patient investor. The basic rule: don't sell your investment for any period shorter than 1 year and 1 day. 3 strategies to legally slash your capital gains tax. Strategy 1. Use tax-advantaged retirement accounts. Accounts like 401ks, traditional IRAs, SEP IRAs, and Roth IRAs allow investments to grow without triggering capital gains taxes every time you buy or sell inside the account, even if you do it under a year. The Roth IRA deserves special mention. Because you fund it with after-tax dollars, all growth and qualified withdrawals are completely tax-free. Strategy 2. Hold as long as possible. Every day you hold a winning investment without selling is another day you don't owe the IRS anything. The wealthiest investors in history, Buffett chief among them, have built fortunes in part by doing almost nothing, buying high-quality assets and refusing to sell. As Buffett has observed, a dollar never paid in taxes compounds indefinitely. How does Buffett pay his bills? One might ask, if Warren Buffett simply buys and holds and never sells his stocks, where does he find the money to pay his bills? Great question. Remember, Buffett is also a business owner and receives a salary, albeit a modest $100,000. He also receives hundreds of millions in dividends from his stock holdings. He also owns other assets, like insurance, railroads, and utilities that produce a huge amount of cash flow. And while he rarely sells his stocks, he does sell from time to time to reallocate his holdings. Strategy 3. Harvest losses to offset gains. If you have investments that have declined in value, you can sell them to realize a capital loss, which offsets an equivalent amount of capital gains elsewhere in your portfolio. If your losses exceed your gains in a given year, you can deduct up to $3,000 against ordinary income and carry the rest forward to future years. One important caveat: after you sell a position at a loss, you must wait at least 30 days before buying the same or substantially identical security back. This rule, known as the wash sale rule, prevents you from claiming the loss while never actually exiting the position. The wash sale rule does not apply if you sell a position for a gain. Real estate, special rules, special opportunities. Your primary residence. The tax code bestows a remarkable gift on homeowners. If you have lived in your primary residence for at least 2 of the past 5 years, you can exclude up to $250,000 in profit from capital gains tax, or up to $500,000 if you are married filing jointly. For many American families, this represents the single largest tax-free transaction of their lives. Investment property and the 1031 exchange. Rental properties and investment real estate face a more complex tax landscape. When you sell, you owe capital gains tax on your profit, but also a 25% depreciation recapture tax on the deductions you claimed over the years. Together, these can consume 40 cents of every dollar of gain. The 1031 exchange, also called the Starker exchange, offers a legal escape hatch. By reinvesting the proceeds from a property sale into 1 to 3 like-kind properties within 180 days, you can indefinitely defer both the capital gains tax and the depreciation recapture tax. Savvy real estate investors use this strategy repeatedly throughout their lifetimes, pyramiding their holdings without ever triggering a tax bill, and ultimately passing properties to heirs through a stepped-up cost basis, which can eliminate the deferred taxes entirely. Depreciation, a hidden treasure in rental property. The IRS allows rental property owners to deduct 1/27.5 of the property's value each year as a depreciation expense, even if the property is appreciating in market value. On a $275,000 rental home, that's a $10,000 annual deduction. Over 27.5 years, you shelter $275,000 of income from taxes. This is one of the most powerful tax benefits available to ordinary investors. The self-employed advantage, a treasure chest of deductions, retirement plan contributions. A solo 401k allows you to contribute up to $72,000 per year in 2026, combining employee and employer contributions, every dollar of which reduces your taxable income immediately. Home office. The portion of your home used regularly and exclusively for business is deductible, including the proportional share of rent or mortgage interest, utilities, insurance, and repairs. A 15% home office means 15% of your electricity bill is a business expense. Health insurance premiums. Self-employed individuals can deduct 100% of health, dental, and qualifying long-term care insurance premiums. Given the staggering cost of healthcare, this deduction alone can save thousands annually. Vehicle, travel, and meals. Business-related driving, travel, and client meals, at 50%, are deductible with proper documentation. These deductions accumulate quickly for anyone who regularly travels for work. Education and professional development. Courses, books, and seminars that maintain or improve skills in your current business line are deductible. The IRS is essentially subsidizing your self-improvement, provided it is tied to your existing work. The QBI deduction. The Tax Cuts and Jobs Act of 2017 introduced the Qualified Business Income Deduction, which allows eligible self-employed individuals and pass-through business owners to deduct up to 20% of their business income. Note, as of early 2026, the 20% Qualified Business Income (QBI) deduction, originally set to expire under the Tax Cuts and Jobs Act (TCJA), has been made permanent by the One Big Beautiful Bill Act (OBBBA). Tax-advantaged savings vehicles, making every dollar work harder. The 529 College Savings Plan. Contributions grow tax-free and withdrawals for qualified educational expenses, tuition, books, room and board, even K-12 private school tuition, up to $10,000 per year, are entirely tax-free. The plan is also remarkably flexible. The beneficiary can be changed, contributions can be superfunded, up to 5 years of annual gift exclusions in one lump sum, and since 2024, unused balances of at least $35,000 can even be rolled over into a Roth IRA for the beneficiary after 15 years. Thanks to the One Big Beautiful Bill Act, OBBBA, signed into law on July 4, 2025, the annual withdrawal limit for K-12 expenses doubled from $10,000 to $20,000 per beneficiary beginning in tax year 2026, meaning I can now withdraw up to $20,000 per year tax-free for her private school. The OBBBA also significantly broadened what qualifies. Beyond tuition, 529 funds can now cover curriculum materials, books, online educational tools, tutoring, standardized test fees, dual enrollment fees, and educational therapies for students with disabilities. Withdrawals for college and graduate school remain unlimited and tax-free, and whatever remains after her education can roll over into her Roth IRA, also tax-free, or be transferred to her future children. The tax benefit of hiring your own child. Here is a 3-part strategy that, implemented correctly, is worth far more than the price of this book. I operate a Taekwondo school. My daughter is a black belt and serves as one of my junior instructors. I pay her approximately $12,000 per year for legitimate, documented work, and because her earned income falls below the standard deduction threshold, she owes no federal income tax on it. I, however, can deduct the full $12,000 as a legitimate business expense. One transaction. Her wages are tax-free to her and tax-deductible to me. That $12,000 goes directly into a Vanguard 529 account invested in a low-cost total stock market index fund, where it grows completely tax-free and funds her education and retirement, as described in the previous section. To summarize, I receive a business deduction, pay no tax on the income, fund her entire education tax-free, and seed her retirement account, all from the same dollars. A few important notes. For this strategy to pass IRS scrutiny, the work must be real and documented, the wages must be reasonable for the role, and payroll must be handled properly. The IRS examines family employment arrangements closely, and the strategy only works if it is executed correctly. Note also that state tax treatment varies. While distributions are federally tax-free, some states have not yet conformed to the OBBBA changes, so check with your CPA about your specific state's rules. Consult a qualified tax advisor before implementing this strategy, but do implement it, because when done right, it is entirely legal and remarkably efficient. The Health Savings Account, HSA. For those enrolled in an IRS-approved high-deductible health plan, HDHP, the HSA offers what financial planners call a triple tax advantage. Contributions are tax-deductible, growth is completely tax-free, and withdrawals for qualified medical expenses are tax-free as well. That combination, pre-tax in, tax-free growth, tax-free out, makes the HSA the most tax-efficient savings vehicle in the entire U.S. tax code for those who qualify. After age 65, an HSA functions like a traditional IRA. Withdrawals for any purpose are taxed as ordinary income, but the ongoing ability to use funds tax-free for medical expenses makes it uniquely flexible. One important limitation: the HSA requires enrollment in an HDHP, faith-based health-sharing ministries, including Samaritan Ministries and MediShare, which my family uses and values, do not qualify because the IRS does not classify them as insurance. If you participate in one of these ministries, the HSA is not available to you. That is a real trade-off worth factoring into your decision, though for many believers, the community, values, and cost savings of a sharing ministry more than compensate. Gift and estate planning: the IRS's generous limits. Every year you can give up to $19,000 per person, 2025, to as many people as you wish without triggering the gift tax. A married couple can jointly give $38,000 per recipient. Beyond the annual exclusion, the lifetime exemption allows an individual to transfer up to $13.99 million in assets before any federal gift or estate tax applies. For most families, disciplined use of annual gifting, particularly to fund 529 plans or Roth IRAs on behalf of children and grandchildren, can transfer substantial wealth across generations entirely tax-free. Getting your inheritance early. Some of you may be wondering, I love the idea of receiving my inheritance earlier, but why would my parents ever agree to it? Here is the case to make. The current lifetime gift tax exemption is approximately $13.99 million per individual under the 2025 One Big Beautiful Bill Act, meaning your parents can transfer nearly $14 million over their lifetime before the federal government takes its 40% cut of anything above that threshold. There is no guarantee this exemption will increase in future years, particularly given the trajectory of the national debt. But here is the more immediate opportunity. Each year, the IRS allows your parents to give up to $19,000 per person, $38,000 as a couple, to as many recipients as they wish, completely free of gift tax and without touching the lifetime exemption at all. That means a married couple with 2 adult children and 4 grandchildren could transfer $228,000 per year, every year, without a single dollar going to the government. If your parents love you more than they love the government, they may be persuaded to distribute your inheritance earlier, up to the annual limit each year. In my own case, the conversation was not difficult. By helping my parents grow their net worth through strategic investments, a 5-fold increase over 20 years, I had already demonstrated that the money would be well stewarded. They were glad to share some of it with my family while they were alive to see it put to use. The takeaway: play the long game. The tax code is long, complex, and frequently revised, but its fundamental logic has been consistent for decades. It rewards patience, long-term capital gains, enterprise, business deductions, planning, tax-advantaged accounts, and investment, favorable capital gains rates. It penalizes passivity and short-term thinking. You do not need to become a tax attorney to benefit from this understanding. You need 3 things: a competent CPA or tax advisor who works with investors and business owners, a basic literacy in the strategies described in this chapter, and the discipline to implement them year after year. Every dollar you legally keep from the IRS is a dollar that can compound in your investments for decades. At a 10% average annual return, a $10,000 tax saving today becomes $174,000 in 30 years. Making peace with Uncle Sam is not about resentment or evasion. It is about understanding the rules of the game well enough to play them to your full legal advantage. Chapter 7.